Greetings everyone and welcome to our simplified stock investment course. So as I mentioned earlier, stock investment refers to buying shares in a company. So there are two strategies you can use. There are people that use value investing, and there are those that use a strategy known as growth investment. So in this lesson we are going to focus on value investment. So value investment refers to value investment is an investment strategy that involves buying outstanding companies for sensible prices. If you look at this definition, the first thing that I want you to underline is outstanding companies. What is an outstanding company? An outstanding company is a company that is making good profit on a consistent basis, a company that is under good management, a company that you are sure is not going to lose your money by going bankrupt. Then sensible prices is buying a company. There are two, let me say there are four instances. There are two types of companies. There are companies that are doing well, and there are companies that are doing not so well. There are companies that are making losses or doing badly off. So the first qualification for a company to qualify for value investment, the company has to be doing well. Then a company can be doing well and selling for a very expensive prices. You can get a company like Facebook, for example. I'm just giving an example. Maybe Facebook is doing very well, making profit on a consistent basis, but the prices are extremely high. Then you get another company that is making profit, doing well, but selling for a price that is realistic. So a company has to be doing well financially at the same time and selling for a good price. So if you can buy such a company, then your strategy is known as value investing. Then which metrics do you use to determine the value of a company? There is a company in the market. What do you look at before you buy? So the first thing you have to do is look at the profit in relation to the price. So if a company is making profit, then you're sure the company is doing well. Then the next thing, you look at the dividend payment. How much dividend are they paying? Are they paying dividends on a consistent basis? Then the next thing, you look at the equity. How much land, how much buildings, how much assets do they have? Then you subtract the liability, then you're left with the equity. If they have a very large equity in relation to the price, that's a good company. Then you also look at the growth. That's not indicated here, but you look at the growth. You want to buy a company that's growing very fast, a company that is making a profit of 10 million now, but 10 years from now they will be making double or triple that. Next, we do a comparison: value investing versus value trading. So value investing is a long-term strategy, a long-term approach. You are buying undervalued stock and holding them for a long term. And what do you get? So when you buy and hold them for a long time, first you get dividends, then you get capital gains. So you get, at the end of the year, you get a percentage of the profit. Then at the same time, the price continues to go up. For example, the stock is worth 10 shillings now. 20 years from now, it's worth $50. It's worth $17 now. 1 year from now, it's worth 25. At the same time, it's giving you dividend. Contrary to that, value trading is a short-term approach where you buy undervalued stocks and hold on to them while looking to sell. I'm going to give you an example of the two. Value investing, you buy land, you construct a building, and you rent it out. That's value investing. Then value trading, you look for land that is selling at cheap prices, you construct houses, then you look to sell immediately, then you invest in something else. That's the difference. That's all. Thank you for watching. Subscribe, turn on the notification button.